Lonsec wishes to remind that the information we provide on our portfolios is general advice, and we encourage investors to read the PDS or seek professional advice prior to making any decisions on their investments.
Hi, I'm Martin McGrath from Financial Edge Group. Today, we're fortunate enough to be sitting down with one of the experts in the industry. We work very closely with Lonsec, and we're fortunate to have Lucas to help kind of answer some questions about what's happening in the market at the moment. And so let's dive into some questions with Lucas.
One of the interesting things from an Australian perspective, so we have seen interest rates go up in other countries. So New Zealand, for example, have raised rates. I think Norway has raised rates. One of the things from an Australian perspective is, yes, we've seen some inflation in certain goods, and services. But one of the areas where we're yet to see inflationary pressure is in wage growth. So from an Australian perspective, unlike in the US, for example, where they have had wage growth, from an Australian perspective, we haven't had wage growth. Anecdotally, people will say, there's a shortage of workers in, if you want to hire someone in a cafe, for example, it's very hard to find people to work. But more generally outside, wage growth hasn't really been there. And so our sort of base case is, yes, there is inflationary pressures, but we don't think that in the short term rates from an Australian perspective will go up. I could be wrong, but wage growth is something we've been watching very closely, because that is the thing. And the RBA has pointed to that for some time. If we did see wage growth, we'd see that we do think then the rates will be more likely go up. And then to the second part of your question, rates going up, generally speaking, asset classes such as, bonds, asset classes such as listed property, infrastructure, these sort of assets generally are adversely impacted by interest rate rises because they are more sensitive to interest rates. But the key thing is to note it's the extent. It's the materiality. So if you think about inflation more generally, inflation actually isn't always a bad thing. It's what type of inflation. If you get out of control inflation, that's bad for every asset class. If you get moderate inflation, it's actually not too bad. It's not too bad for equities and so forth. So it's more around the extent. What I would say is that the way we sort of think about it, while we don't think out of control inflation is the base case, so to speak, we still want to ensure that portfolios have some level of exposure to assets that would tend to do okay if we did see more inflation. So, there's a lot of variables. I think at the moment, there's probably more unknowns than knowns today. So diversification is important from a portfolio perspective. But our base case still at the moment is that we're not going to see rates go up aggressively from an Australian perspective.